Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We've got a good one today.
We certainly do. Today, we're breaking down one of the most important, but maybe least understood, companies in the entire global financial system, Intercontinental Exchange, or as you probably know it, ICE.
ICE. Most people hear that and they just think of the New York Stock Exchange, the opening bell, the floor traders you see on TV.
Exactly. And on the surface, it looks like this incredibly stable, powerful institution. But the real question for us as long-term investors is this. What really makes ICE an enduring business, and are its high-margin, recurring revenue streams strong enough to justify what looks like a very premium valuation, especially with all the debt they've taken on? That's what we're here to find out.
That's a massive question, and before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. Where do we even start with a company this complex?
Well, I think you have to start with the idea that this isn't one business. It's a carefully constructed, vertically integrated machine with 3 distinct parts.
3 pillars, right? And this wasn't an accident. This was a deliberate strategy.
Oh, absolutely. It's their blueprint for resilience. If you can get your head around these 3 pillars, you basically understand the entire value proposition of ICE. And they're fascinating because they all make money in fundamentally different ways.
Which means they can kind of hedge against each other when the market gets choppy.
That's the idea. So let's start with the one everyone thinks they know, the exchanges.
The classic business. This is the part that I assume lives and dies by market volatility.
Precisely. The exchanges segment is, well, it's the historical core of the business. All your revenue there comes from transaction fees, clearing fees, and of course the listing fees.
And that's where the NYSE franchise comes in.
The NYSE is the crown jewel of that segment, for sure. But don't forget their global futures and options markets. I mean, they are dominant in energy. ICE Futures Europe is basically where the world comes to set the price for Brent crude oil.
So a huge global footprint. And the margins on that must be incredible.
They are. I mean, we're talking gross margins well north of 70%. It's a fantastic business when it's firing on all cylinders. But, and this is the big but, it's completely volume dependent.
If the world gets quiet, their revenue dries up.
Exactly. If global trade slows down, if central banks manage to kill all the volatility, or, if we just enter a long, boring period in the markets, this segment is going to feel it. That revenue stream can, and it absolutely will, have cyclical downturns.
Okay, so that's the high-octane engine. It's high margin, but it's also high variability, totally dependent on what's happening in the world, geopolitics, you name it. So where's the anchor? What do they have that counteracts that cyclicality?
That brings us right to pillar number 2. And honestly, this is the part that gets me most excited as an investor. It's fixed income and data services, or FIDS.
FIDS, okay.
This is the quality core. This is the part of the business that the market is willing to pay that premium multiple for. Because unlike the exchanges, FIDS revenue comes from stable, predictable, highly recurring subscription fees.
So this is a subscription model, like a SaaS business almost.
In a way, yes. Think about who their customers are. We're talking about massive pension funds, asset managers, global banks, and they're not subscribing to this data because it's interesting.
They're subscribing because they have to.
They have to. They are often mandated by regulation to use this kind of centralized, trusted data for their risk management, for their compliance, for valuing their own portfolios. We're talking about things like bond analytics, pricing feeds, and the big indices like the ICE BUFA indices that track the bond market.
You just hit on something really important there. It's the difference between required data versus just desired data.
It's the whole game. It means when a bank's CIO needs to tighten the budget, they can't just call up ICE and say, you know what, we're going to skip the risk management data this quarter. It's not an option.
So that's the buffer. When trading on the exchanges goes quiet, the FIDS subscriptions just keep rolling in. It's a non-cyclical anchor.
A powerful one. And it's a beautiful model because they take the proprietary information that's being generated on their own exchanges and clearinghouses, and they refine it, package it, and sell it back to the market as these high-margin, indispensable products.
Okay, so pillar 1 is volatile transactions. Pillar 2 is stable subscriptions. What's pillar 3? This is the newer piece of the puzzle, right? The one where they've been spending a lot of money.
That's right. This is where you see management's focus, especially with recent M&A. And it also carries, as you said, the most integration risk. We're talking about the mortgage technology segment.
Right, the giant Black Knight acquisition.
That's the centerpiece. This segment is an aggressive, really targeted bet on digitizing a massive, inefficient industry. The revenue here is a mix of subscription and transaction fees, all generated by platforms that are trying to streamline the just unbelievably fragmented U.S. residential mortgage process.
And that process is famously awful. It's paper-heavy, it's slow.
It's a mess. And IC's bet is to digitize that entire life cycle. Everything from the moment a loan is originated all the way through decades of servicing. It's a structural play on modernizing an industry that is, in many ways, still stuck in the past.
What's so compelling when you lay it out like that is that the whole three-pillar model seems almost timeless. It's built on fundamental needs that aren't going away.
I think that's exactly the right way to look at it. If you zoom out, each pillar is addressing a core, almost eternal human and economic need, the exchanges. That's our need for risk transfer and price discovery.
Been around since the first marketplaces.
FIDS. That's our response to complexity. As the financial world gets more complicated, the need for trusted, centralized data for valuation and regulatory compliance only goes up. And mortgage tech, that's just a pure bet on productivity and efficiency in one of the biggest markets on the planet.
So as long as people need to trade risk, value assets, and buy houses.
IC's infrastructure becomes more and more critical. This is not a business that's at risk of becoming irrelevant anytime soon. Its role as that trusted, centralized, tech-driven operator is only getting stronger.
Okay, so that's the what. Now let's get to the how.
This is where it gets really interesting for me. You can't command the kind of valuation ICE has without an absolute fortress of a competitive moat. How do they actually defend this position against really smart rivals like CME or NASDAQ?
The moat it's a beautiful thing to analyze, actually. It's not one single thing. It's more like a strategic combination punch. You've got these incredibly powerful network effects, especially in the exchanges. You layer on top of that nearly insurmountable high switching costs in the data and mortgage businesses.
And there are other factors too, right?
Oh, yeah. All of that is built on a foundation of critical intangible assets. We're talking about things you can't easily replicate, like the regulatory licenses to operate these systemically important clearinghouses, and of course the immense brand prestige of something like the New York Stock Exchange.
Let's break those down. Let's start with the exchanges and the network effect. This feels like the oldest trick in the book for an exchange business. It's old because it works, and it is overwhelmingly powerful. The concept is incredibly simple. Liquidity begets more liquidity.
The rich get richer.
Pretty much. Traders, big banks, hedge funds, they all have to go where the action is. They need to trade in markets with the deepest pool of buyers and sellers because that's where their transaction costs are lowest. That's where they can move in and out of large positions without moving the price against themselves.
So if ICE has the most volume in, say, energy futures,
then anyone who wants to trade energy futures have to go to ICE. And by doing so, they make that pool of liquidity even deeper, which in turn attracts the next trader. It's a self-reinforcing loop, a virtuous cycle.
and any competitor faces a huge uphill battle, a cold start problem.
A massive one. Imagine trying to launch a new exchange to compete. Your first question is, why would anyone trade with me if my counterparty isn't here yet?
Right.
It's extraordinarily difficult to break that structural dominance unless you have deep, deep pockets to subsidize trading for years or you get some kind of regulatory help.
Okay, so that's the network effect. But you said the real durability, the thing that makes the moat wider over time, comes from the other segments, from the switching costs.
Yes, this is the crucial mechanism. If you want to understand why ICE is such a durable business, you have to focus on the high switching costs, particularly in the data and mortgage tech businesses.
So walk me through that. Let's say I'm a huge bank, a customer of ICE. How are they locking me in?
Okay, so think about how a major financial institution actually operates. They don't just, have a trader pull up a web page to casually check ICE's bond prices. It's not like that at
How
all.
much deeper?
It's deeply embedded. They integrate ICE's proprietary data feeds, the bond pricing, the reference data, the indices, deep into their core mission-critical internal systems. I'm talking about the risk management models that determine how much capital the bank has to hold against its assets, the compliance systems that are automatically flagging suspicious trades for regulators, the portfolio valuation engines that have to strike a NAV and net asset value for their funds every single day.
Wow. So if that bank's CFO wakes up one morning and decides to save a few bucks by switching to a cheaper data provider,
It would be a nightmare. They would literally have to tear apart the engine block of their entire operational and compliance infrastructure.
that's a great analogy.
It would take hundreds of their internal engineers, months, maybe even years of work. They'd be risking a multi-million-dollar failure in their compliance reporting. Just think about the regulatory risk alone of ripping out a pricing feed that your regulator has already approved and replacing it with some new, unproven one. It's a non-starter.
So the cost of switching isn't just the price of the new subscription. It's the time, the engineering cost, and this massive, terrifying operational risk.
That's it. And that risk vastly, vastly outweighs any marginal savings they might get on the subscription fee. So once a customer is integrated, they are in. They are not leaving.
And that stickiness is what gives them their pricing power. They can raise prices year after year, and their customers that just have to pay it.
For the most part, yes. And this is the beauty of their strategy. Every time they expand the FIDS business or integrate a new part of the mortgage workflow, they are structurally increasing those switching costs across their entire customer base. It makes the whole enterprise far less reliant on the day-to-day whims of the trading markets. It's a strategy designed to widen the moat over time.
This whole discussion of the moat, the infrastructure, it leads perfectly into a mental model that I know you like to use for this kind of business.
It does. It brings us to the Charlie Munger toll bridge mental model.
I think this is probably the most powerful and simple way for an investor to really conceptualize what ICE does.
It really is. ICE is the quintessential toll bridge business. But it's a special kind of toll bridge. It's one that's built with cutting-edge proprietary technology, and crucially, it's sanctioned and protected by regulators.
So they're not taking the risk of the cars crashing on the bridge.
Not at all. They are not taking the risk of the financial transaction itself. They are simply providing the essential high-tech road, the marketplace, the data feed, the clearinghouse that absolutely everyone must use to safely cross the financial river. They own the road and they own the gate.
And that gate ownership, as you said, is reinforced by those regulatory licenses, which acts as this massive barrier to entry for anyone who thinks they can just go build a competing bridge.
It's an almost insurmountable barrier. They hold the critical license to just skim a small but very high margin and highly defensible fee from nearly every major type of transaction that happens on their platform.
So whether it's a trader in London hedging billions in energy futures,
Or a pension fund in Tokyo complying with global regulations using their proprietary bond pricing.
or now a bank in Texas closing a U.S. home mortgage.
In every case, ICE is there collecting its toll. It's a business model that is just engineered for incredible profitability and very, very low competitive erosion.
Okay, but this world isn't a total monopoly. It's more of an oligopoly. You have some really tough, sophisticated rivals out there. You mentioned CME Group, you mentioned NASDAQ. How does ICE's strategy and advantage really stack up against those peers?
That's a really important question. You have to understand how their strategies differ. Let's start with CME Group, based out of Chicago. They are the undisputed king of derivatives clearing, full stop.
What are their specialties?
They are completely dominant in interest rate products, things like Eurodollars, SOFR futures, as well as foreign exchange and equity index futures like the S&P 500. The network effect they have in those specific product sets is frankly unrivaled. Nobody can touch them there.
Okay, so CME is the rates and equity index giant. What about NASDAQ? Their strategy seems a bit different.
NASDAQ is more of a hybrid. They obviously run their exchange, but they've made a huge strategic push into selling technology solutions, particularly anti-financial crime software, to banks and brokers all over the world. So they're part exchange, part enterprise software company.
So if CME is the focused derivatives champion and NASDAQ is pushing into software, what is ICE's unique, durable advantage against them?
ICE's advantage is its unparalleled vertical integration and its diversification of assets across different market cycles. I mean, nobody else has this specific combination of businesses.
Let's tick them off.
First, they own the absolute gold standard in the listings franchise with the New York Stock Exchange. That's a unique asset. Second, they have that formidable global presence in energy and commodity futures. That's their turf. But the crucial differentiator is the strategic pivot we talked about.
The recurring revenue.
The rapidly expanding, incredibly sticky recurring revenue from both the data services and the mortgage tech businesses. That combination ensures that they are not overly reliant on any single part of the financial markets.
So to put it another way, CME's fortunes are very tightly tied to what happens with interest rates and the stock market.
Very tightly.
But ICE is positioned as a more diversified financial utility. So if derivatives trading slows down, the data subscriptions keep the lights on. And if data growth slows for some reason, the long-term trend of digitizing the mortgage market can pick up the slack.
That is exactly right. They have strategically positioned themselves to capture a fee at almost every stage of the financial workflow. From the very beginning, when a company forms capital with an IPO on the NYSE, to the ongoing risk management with derivatives and data, and now all the way to digitizing the core workflow of an entire related industry. It's this wide interconnected net that makes them, I would argue, fundamentally more robust and offers greater stability than their more focused peers.
Let's shift gears a little bit and talk about the people behind this strategy. Management. I mean, the long-term quality of a company like this rests so heavily on its leadership. And in this case, it's the founder, Jeffrey Sprecher.
Right.
He's been the driving force since, the late 1990s. That is a remarkable long-term founder-led tenure.
It really is. And to understand IC, you have to understand Sprecher's philosophy. It's been the blueprint for their entire strategy for more than 2 decades, and it has been incredibly consistent.
What does it boil down?
It's simple. Buy market infrastructure, apply proprietary technology to make it efficient, and then monetize the resulting data and workflow tools. That's the playbook.
So it's a transformation strategy, not just a maintenance one.
Exactly. He looks for fragmented, often old-fashioned manual market infrastructure. Think about the old open outcry pits of the London energy market, the IPE, or the iconic but archaic paper-driven floor of the NYSE. He acquires these assets, and then he uses technology to make them vastly more efficient, fully electronic. And then the final step is he takes all the proprietary data that this new electronic system generates and turns it into high-margin products.
Can you give us an example? The NYSE acquisition itself seems like the ultimate case study for that.
It's the perfect example of his long-term vision. That was not a simple deal. It was a massive, multi-year, incredibly complex process. It required huge amounts of regulatory approval, political savvy, and then a massive internal transformation.
He wasn't just buying the brand.
He was not just buying a brand to hang on the wall. He was buying the ultimate regulatory license and the premier listings franchise on Earth. And the moment he got it, he began applying technology to streamline its processes, to integrate its clearing operations into ICE's existing global infrastructure. It was never about preserving a museum. It was always about optimizing a valuable licensed utility for the 21st century.
That really does sound like a true owner-oriented mindset, which is so critical when you're betting on a company to compound for decades.
It is, and his own personal stake in the company confirms that alignment. Sprecher is still the largest individual shareholder. He owns something like 1.3% of the entire company.
That's a huge number for a company this size.
It's a massive amount of skin in the game. And it ensures that his focus is squarely on long-term shareholder value creation. It explains why he's willing to make these big, strategic, sometimes controversial bets like the NYSE back in the day or the more recent massive investment into the mortgage technology platforms that are designed to expand the moat over a decade, not just boost next quarter's earnings.
That focus on strategic M&A is the perfect segue into capital allocation. With a history of such large acquisitions, how do they actually prioritize where their cash flow goes? What does that track record tell us of the quality of this management team?
I think their history shows a very disciplined, compounding-focused approach. They're always focused on expanding the structural quality of the entire asset base, not just, chasing a temporary spike in trading volume.
And priority number 1 is clearly strategic M&A. That seems to be the core engine of their growth.
Strategic M&A is number 1, absolutely. And their acquisitions tend to be successful because they are so focused on synergistic targets. They look for businesses that either expand the moat or, even more importantly, increase the overall percentage mix of that sticky recurring revenue.
So the Black Knight acquisition is a perfect example of that.
A perfect example. They weren't just buying a software company, they were buying a critical layer of technology that was already deeply embedded in the daily workflows of major U.S. banks. In one move, they dramatically widened their switching cost moat into a massive new sector.
And what's priority number 2 after M&A?
Reinvestment. They commit a substantial amount of capital to reinvesting back into the business. And this means that technology spending aimed at market efficiency, system redundancy, which you can't skimp on when you're a systemically important utility, and of course, aggressively expanding their data services offerings.
So that reinvestment feeds directly back into widening that switching cost moat we talked about earlier.
Directly. It ensures their proprietary data feeds remain best in class and become even more deeply integrated into their customers' operations.
And then finally, shareholder returns, the dividends and buybacks.
They maintain a good balance here. ICE has, I believe, 11 consecutive years of dividend growth, and they complement that with opportunistic share buybacks when they see value. But the key takeaway is the rationality of it all. Their capital allocation is designed to methodically transform these transactional businesses into highly defensible, technologically advanced information utilities that are built to compound value over a very long time.
Okay, so we have a great strategy, a proven, aligned leader. What does that foundation actually look like when you put it under the microscope of financial ratios? Give us the numbers that prove this is a high-quality business.
The financials really do reflect a fortress. I mean, it's a fortress built on incredible efficiency and consistency, and it's heavily buffered by that growing stream of recurring revenue. The margins to start are just exceptional.
How exceptional are we talking about here?
We're looking at gross margins that are approaching 78% and operating margins that consistently hover around 39%.
Those are software-level margins.
They are software-like margins being applied to essential regulated financial infrastructure. That level of profitability just underscores their oligopolistic position and their immense pricing power. And that recurring revenue base ensures that even if we hit a nasty global trading slump, the company's profitability doesn't just fall off a cliff, it maintains a very high floor.
Okay, let's talk about efficiency. How efficiently are they deploying all of this capital? Let's look at return on invested capital, or ROIC. The normalized figure is around 9.12%. Now, for some of our listeners who are used to seeing tech companies with ROICs of 20 to 30%, that might sound a little modest. Why is that 9.12% actually a sign of structural quality in this case?
That is a critical point, and it requires some context. You're right, 9.12% might look low next to, say, a pure-play asset-light SaaS company.
Yeah.
But for a business that owns systemically important, highly capital-intensive assets, we're talking massive clearing systems, proprietary data centers, a global network, that is a phenomenal return.
It's about what you're getting a return on.
Exactly. And the reason this number confirms the quality of the business is twofold. First, this model, once the initial investment is made, just gushes cash flow. The ongoing maintenance capital expenditure is relatively low. But second, and this is the most important part, that 9.12% is significantly above their estimated weighted average cost of capital, their WACC.
So the spread between what they earn and what their capital costs is the key metric.
The spread is where all the value is created. Because ICE's business is so stable and regulated, their cost of capital, their WACC, is relatively low. As long as they can consistently maintain a healthy spread over that cost, every single dollar they reinvest or use for an acquisition is generating more value for shareholders than it costs. It confirms that ICE is a true value-creating enterprise, even if the absolute ROIC number looks lower than a pure software company.
Got it. And finally, what about cash flow conversion? With that asset base, how efficiently do their earnings actually translate into cold, hard cash?
It's excellent conversion. The business model, especially on the exchange and data services side, just doesn't require a lot of ongoing CapEx. They don't have to build massive new factories or distribution centers every year, and that translates into very high free cash flow conversion from net income, which is really the hallmark of a high-quality, asset-light financial infrastructure model. They just generate massive amounts of cash that they can then deploy.
Now, we have to talk about the elephant in the room, the balance sheet, specifically the debt. These major transformative acquisitions require significant leverage, and the net debt to EBITDA ratio right now is elevated, sitting at around 4.9 times.
It is high.
And I take your point about the stable cash flows from FIDS, but that 4.9x leverage spike comes directly from making a huge bet on the mortgage market, which is notoriously volatile. How do we square ICE's traditional image of stability with the inherent cyclicality and, frankly, the recent interest rate pressure on their brand new mortgage tech segment. Aren't they just using the stable utility cash flow to subsidize a highly cyclical bet?
That is the essential challenge for the current investment thesis, and it's a perfectly fair challenge. The 4.9x ratio is high, no question, and it's almost entirely due to the Black Knight acquisition. But the market, and certainly ICE's management, would argue they see it differently.
Oh.
They argue that because the cash flows from FIDS and the stable exchange clearing fees are so predictable, so utility-like, they can service this level of debt comfortably. They are, as you said, using the stable earnings to fund what they see as the future growth engine.
But that growth engine, the mortgage tech segment, is directly sensitive to interest rates. I mean, when rates spiked and the refinance boom ended, those transaction-based revenues took a real hit, and that makes that new pile of debt look a lot heavier.
Correct. And that is exactly where the execution risk lies for investors today. But you have to understand, ICE believes they are not making a cyclical trading bet on mortgage volumes. They are making a long-term structural technology bet.
A bet on the workflow, not the volume.
Exactly. They believe that even if loan origination volumes dip cyclically because of interest rates, the fundamental need for workflow digitization and the stickiness of the servicing technology they acquired remains structurally high and will grow for years. Their plan is to aggressively pay down debt over the next 24 to 36 months, using that free cash flow and the synergies they get to return to their target leverage range of around 3 to 3.5 times.
But they have to execute.
They absolutely have to execute. The market is giving them permission to carry this debt today only because the intent is to complete this transformation from a cyclical player to a sticky tech utility. They have to integrate this acquisition flawlessly to maintain that permission from the market.
Let's shift away from the hard numbers for a minute and talk a bit more about the Scuttlebutt, the qualitative view. How is this company actually perceived by the outside world, specifically by its customers and its employees?
The customer view is fascinating because it provides direct evidence of the Moat's strength. When you talk to their customers, the big financial institutions, they view ICE's core products not really with affection or love, but as indispensable required infrastructure.
They're the power company. You need them to function.
That's a perfect way to put it. And for an investor, that tolerated but required status is actually a much better indicator of a strong moat than customer love, because it signifies deep structural pricing power.
And the evidence for that is pretty clear.
It's all over the place. You see it in the constant market chatter and the recurring regulatory scrutiny over their high data fees. If your customers are complaining loudly about how much you charge, but they keep paying it year after year because the liquidity, the utility, the compliance value is simply unmatched, well, that is direct quantitative proof of your pricing power. They are charging a toll, and the travelers have no other viable road to take.
That's a powerful position to be in. What about internally? Stability among employees is pretty critical when your job is to manage systemically important infrastructure.
It's very high. Their voluntary attrition rate is consistently below the benchmarks for the sector. And that suggests a very stable workforce and a culture that is really focused on integrity, on long-term problem solving, and on system reliability, which is exactly what you want to see when your business is basically the central artery of global finance. You don't want a lot of churn in that kind of environment.
Okay, let's move on to the final and maybe the toughest hurdle for any investor looking at this company today: valuation. The market clearly recognizes the quality we've been talking about, and that results in a premium valuation. The PE on a non-GAAP TTM basis is around 23 times. Why does the market justify paying that kind of premium for a company with a massive and, let's face it, somewhat mature exchange segment?
The justification really boils down to two things: that monopolistic pricing power we just discussed, and more importantly, the quality of its future growth. The market is willing to award a higher multiple to ICE than it would to, say, a typical industrial or utility company because of the growing contribution from those stable, high-margin, recurring, subscription-based revenue streams.
FIDS and mortgage tech.
Exactly. That deliberate shift away from volume-dependent transactional revenue toward predictable subscription revenue structurally de-risks the entire business over time. And a less risky, more predictable business deserves a higher multiple.
So if the quality is, for the most part, undisputed, where does a potential investor find their margin of safety? It's pretty clear you're not going to get this thing at a historically low PE ratio. Those days are probably long gone for a company of this caliber.
That is such a critical insight for anyone investing in these kinds of wonderful businesses. The margin of safety for a company like ICE is not found in a cheap price relative to its normalized earnings. It's found in the enduring quality of the franchise itself and the resilience of its cash flows. So, as an investor, you have to be patient. You have to wait for an opportunity to buy these quality assets at a temporary discount, usually driven by some kind of short-term fear or uncertainty in the market.
Can you give me some specific examples? What kind of temporary headwinds should an investor be patiently watching for?
I think there are three main scenarios where a company like ICE can become temporarily mispriced. The first is the most obvious, a major cyclical downturn in global trading volumes. The exchange revenue dips, the stock price follows it down, but the underlying FIDS revenue remains stable, which eventually proves the resilience of the overall model. That's a classic opportunity.
What's the second one?
Second would be a broader market-wide panic. A liquidity crisis, a geopolitical shock, something that temporarily depresses the stock prices of all financial utilities, regardless of their individual quality. A classic throwing the baby out with the bathwater scenario.
And the third scenario seems like it would relate directly to that complex, high-stakes M&A strategy they're running.
Absolutely. The third and maybe most likely opportunity would be a post-acquisition integration setback. For example, you could see some short-term earnings noise, maybe higher than expected costs related to integrating the new mortgage technology business. Or some complexity arises and delays in realizing the cross-selling synergies they promised, or maybe some initial resistance from the industry to adopting their new platform.
So if that kind of noise causes a temporary dip in the stock price, but it doesn't do any permanent damage to the long-term structural business model.
That is the investor's opportunity. That's when you get the chance to acquire this exceptional quality at a much fairer price.
Okay, looking forward, how does ICE generate sustainable, long-term growth from here?
The core exchange business is pretty mature. So we need to dig a little deeper into the functionality of that mortgage technology segment to really understand the growth trajectory.
You're right. The future growth engine is almost entirely on the recurring revenue side of the house. It's primarily FIDS expansion and, most critically, ICE mortgage technology. The FIDS growth is pretty straightforward. They're just constantly taking their proprietary data streams and processing them into new, higher-margin analytics tools that institutions simply can't replicate on their own.
But let's really focus on mortgage tech. Just saying they digitize the process is a little vague. What are the specific pain points in the U.S. mortgage market that they are actually solving, and what kind of market share are they really targeting? This is where the sheer scale of the opportunity becomes clear. The U.S. residential mortgage market is this massive, multi-trillion-dollar industry that, as we said, has historically been plagued by fragmentation. The process involved originators, who are the lenders, it involves the secondary market investors who buy the loans, and it involves the servicers who collect the payments for 30 years. And ICE, primarily through that Black Knight acquisition, now sits right in the center, integrating all of those disparate processes.
Can you give me an example of some of the platforms they own?
Sure. They acquired crucial platforms like Empower, which is a leading loan origination system. It's used by many of the major banks to handle the entire initial application and underwriting process. They also acquired the core servicing technology that the biggest servicers use. By owning these deeply embedded tools, IC's goal is to create a single, continuous, end-to-end workflow, a unified ecosystem.
So the pain point they're solving is that costly, error-prone handover between dozens of different software systems during the life of a mortgage.
That's it, exactly. They want to provide the centralized backbone that standardizes all the data and communication across the entire industry. And the total addressable market for this kind of digitization is massive. We're talking low tens of billions of dollars annually. And ICE is positioning itself to be the dominant workflow provider, which means they can collect fees throughout the entire life of the loan, not just when it's first created.
So with that as the growth engine, what are the potential catalysts? What are the events that could cause the market to re-rate the stock, to move it beyond its current premium multiple?
Well, the most immediate catalyst is simply the proof of concept for mortgage tech. If they can show successful, efficient integration and start realizing those synergies, if they can prove that the recurring revenue mix is expanding significantly faster than the market expects and that the margins are holding up, that will cause a re-rating.
The market will stop seeing it as just an exchange operator.
The market will stop valuing it as a 23 times earnings exchange operator and start valuing it as a 28 or 30 times earnings sticky tech provider. And then, of course, on a cyclical basis, any sustained spike in global volatility, a geopolitical event, an interest rate shock, would temporarily boost exchange and clearing volumes, providing a short-term lift to earnings that they can then use to pay down debt and fund that long-term growth strategy.
Okay, every investment has risks. Even a fortress with a deep moat has vulnerabilities. Let's talk about the big ones, the structural, permanent impairment risks. Not just a temporary dip, but the threats that could fundamentally break the business model over the long haul.
I think there are two primary structural risks that every single ICE investor needs to have on their radar at all times, because they target the very foundation of the business model and its pricing power.
And the first one, I assume, targets those enviable margins directly.
It does. That is regulatory intervention. Because ICE operates this systemically important infrastructure, particularly in data services and clearing, regulators and governments are constantly scrutinizing them. The big risk is that one day, authorities decide to mandate lower exchange fees or, more likely, lower data fees.
Treating the data as a public good.
Exactly. Treating the proprietary data that ICE generates data that is essential for compliance and market functioning as a public utility that's required for fair markets. If the government fundamentally restricts their ability to charge monopolistic prices for their data, it directly and permanently impairs those high-margin recurring revenue streams.
That would be a direct hit to the quality of the business. What about the longer-term technology risk, the kind of thing that could make their whole centralized model obsolete?
The second risk is that long-term disruptive technology and decentralization. Look, we are talking about the non-zero risk of true decentralized finance, or DeFi, and sophisticated blockchain platforms evolving enough over the next 1 or 2 decades to completely bypass traditional centralized exchanges and clearinghouses.
So if traders can find a way to do it all without them,
If market participants can achieve high volume, reliable price discovery and risk transfer efficiently and safely without the centralized infrastructure that IC provides, then their core clearing and exchange business could eventually become a relic. Now, this is a multi-decade threat, but it is the true long-term technology risk that you have to monitor.
okay, let's pull all this together with some second-level thinking. What is the standard market consensus on ICE right now? And where is the potential edge for an informed investor who's willing to look beyond the obvious?
The prevailing market consensus is actually pretty straightforward. It's ICE is a very high-quality, diversified financial utility with a proven, brilliant CEO and an unrivaled moat. But it is currently fully valued at 23 times earnings. Furthermore, the consensus views that growth is inevitably going to slow down as the crazy high trading volumes we saw during the pandemic and the subsequent rate hikes start to normalize.
So the consensus view is great company, but it's at a high price, so you can probably expect low future returns. It sounds like the market is still viewing it primarily as a cyclical financial company. What's the contrarian angle here?
The contrarian view is all about underestimating the structural transformation that's happening under the hood. And this is where I think an informed investor can find their edge. The market is still viewing ICE too much as a cyclical exchange operator whose earnings just rise and fall with market volatility. They are, I believe, underestimating the long-term, high-quality compounding power of the FIDS business and the immense, sticky revenue potential of the fully integrated mortgage tech segments.
And the numbers should eventually prove that out. If the market is wrong, we should see that percentage of non-transactional revenue just keep climbing year after year.
Absolutely. The sustained, aggressive digitization of the U.S. mortgage workflow and the continued expansion of FIDS means that the growth in their recurring revenue is structurally insulating ICE from exchange volatility faster than the market currently realizes. If that transformation continues or even accelerates, proving that they can generate subscription-like margins on a utility-like asset base, then the stock will deserve an even higher multiple than the one it commands today. The edge is betting that the technology transition happens faster and is more profitable than current market expectations.
Okay, let's synthesize everything we've covered into a tight summary. The bull case versus the bear case.
On the bull case, the reasons to own IC are, I think, highly compelling. You have an impregnable toll bridge moat that's driven by network effects and deepening switching costs. You have a founder-led management team with a proven capital allocation strategy focused on structural quality. You have a clear, beneficial shift in the business mix toward high-quality recurring revenue. And financially, it's just a fortress with high structural margins and very strong free cash flow generation.
A pretty compelling list. Now let's hear the bear case. The counterthesis that should give an investor pause.
The risks are equally clear. First, the valuation and the leverage are both elevated right now, largely due to that recent M&A, with net debt to EBITDA at 4.9 times. Second, there is persistent and, I would argue, growing regulatory risk that specifically targets their ability to price their data and access fees. Third, there is that non-zero long-term threat of technological obsolescence from decentralized finance. And finally, and most critically, there is the immediate, very real execution risk of integrating those massive and complex mortgage technology platforms, especially during a period of cyclical weakness in that very sector.
Okay, for our final segment, let's use the Red Team Challenge framework. Let's try to define the single most compelling scenario for why this investment could ultimately fail to deliver long-term returns, especially from today's premium valuation. This forces us to really think about the point of maximum pain for an investor.
This is a great exercise. It forces us to look for the double whammy scenario. So, the high price that an investor pays today is predicated entirely on the future success and the high margin growth of the FIDS and mortgage tech recurring revenue streams. The market is pricing in the successful completion of their transformation into a technology utility.
So if that growth thesis stalls out for any reason, the high multiple is completely unjustified and the stock will derate.
Exactly. But the truly catastrophic outcome happens if that growth stalls at the exact same time that the profitability of their core business gets impaired. Imagine a scenario where new regulatory action successfully curtails the profitability of their core exchange and data businesses. The government cracks down hard on high data fees, treating that compliance data as a publicly regulated utility with strict price caps.
So the old reliable cash cow gets hobbled by regulators.
And at the very same time, the complex integration of the mortgage tech business just stalls out. Maybe due to unforeseen operational complexity, maybe the market resists a single centralized platform, or maybe there are structural shifts in the housing market we don't see coming. The end result is permanent damage. The stock suffers from both impaired pricing power in its essential core infrastructure and a much lower growth multiple, because the promised transformation into a sticky tech company fails to materialize.
That's the nightmare scenario.
Yeah.
Impaired quality and impaired growth happening at the same time.
And that would permanently damage the economic return profile for any investor buying at today's elevated price.
That is a powerful final thought and a vital scenario for anyone to run through their models. To summarize our deep dive, ICE is fundamentally a wonderful, high-quality company. It's defined by an evolving, and I would say widening, moat that's centered on switching costs and data stickiness, and it's led by a proven, owner-oriented capital allocator.
The quality of the underlying business is largely undisputed. That's why the market is willing to give it such a high valuation. The primary investment hurdle, as we've said, remains the price you pay. And an investor has to be highly selective about when they choose to initiate or add to a position in this essential financial utility.
Now, for our final provocative thought for you to mull over. If essential financial market data is successfully designated by governments as a public utility rather than a proprietary high-margin product, what does that mean for the long-term viability of the entire financial utility business model? And more specifically, given ICE's massive new investment, how insulated is its strategic shift into the mortgage technology stack from those same kinds of regulatory and political pressures, especially when it comes to things like consumer data privacy and fair access?
Something to keep in mind as you watch the inevitable convergence of technology and regulation.
Thank you for joining us on this deep dive. We hope this analysis gives you a much stronger understanding of the complex architecture that lies just beneath the surface of global finance.
Until next time, stay well informed and keep compounding your knowledge.